Is the American dream of owning a home dead? For millions, the 2026 housing market feels less like a dream and more like a nightmare. Interest rates are sky high, construction costs have ballooned thanks to inflation, wages are stagnant, and available houses? Forget about it. Let's hit you with some hard numbers. The affordability ratio, that's home price versus income, is flashing red across the nation. Mortgage rates are hovering around 7%, pricing out a generation of first-time buyers. You're looking at needing at least 20% for a down payment, which can feel impossible when the cost of groceries is already draining your bank account. Who's feeling the squeeze the most? Young professionals, families trying to upsize, anyone in a major city like New York or Los Angeles. We're talking about people who should be entering their prime earning years, but instead, they're stuck renting, watching their dreams of building equity slip away. There's a common misconception that homeownership is just about finding a place to live. It's so much more. It's about security, building wealth, and putting down roots in a community. But in 2026, that dream feels increasingly out of reach. The emotional toll is real. Stress, anxiety, delayed family plans. The inability to afford a home impacts every aspect of life. So, is home ownership a lost cause? Absolutely not. The question is, who can still afford a house in 2026 and how are they doing it? Okay, so you're not priced out completely. Let's dissect what affordability really means in 2026. It's way more than just the mortgage payment. Think property taxes. In some states, those can easily add hundreds of dollars or even thousands to your monthly outlay. Then there's homeowners insurance, protecting you from, well, life. Budget at least a few $100s a month, depending on your location and coverage. Don't forget maintenance. Leaky faucets, busted water heaters, the inevitable roof repair. Experts recommend setting aside at least 1% of your home's value annually for maintenance. On a $300,000 house, that's $250 a month just for upkeep. And if you're in a condo or a planned community, add homeowner association, or HOA, fees to the list. And let's be real, you'll probably want to upgrade something. New paint, new furniture. Factor that in too. So what income do you actually need? It varies wildly. To comfortably afford a median-priced home, we're talking around $410,000 nationally. You're looking at needing an income of over $100,000 a year. But in some areas, like California or Hawaii, that number could easily double. Conversely, in more affordable states like Mississippi or Arkansas, you might get away with something closer to $60,000 or $70,000. Location is everything. But here is a massive reality check. Hitting that six-figure income mark doesn't make you bulletproof. You can make $160,000 a year and still be broke if you don't account for life. The bank approves you based on your gross income, but they don't care about your grocery bill, your student loans, or the fact that your AC unit will die in the middle of July. If you max out your budget just to get the keys, one unexpected expense can turn that dream home into a financial prison. Now, debt-to-income ratio, or DTI. This is crucial. Lenders want to see that your total monthly debt payments, including your mortgage, credit cards, student loans, car payments, don't exceed a certain percentage of your gross monthly income. Generally, they like to see a DTI below 43%, but ideally you want to be closer to 36% or lower. Exceed that, and you'll find it tough to get approved, or you'll get stuck with a terrible interest rate. Let's say you make $5,000 a month before taxes. A DTI of 36% means your total debt payments shouldn't exceed $1,800. If your car payment and credit card bills already eat up $800, you're only left with $1,000 for a mortgage payment. That seriously limits your options. Your credit score matters hugely. A higher score translates directly into a lower interest rate. Even a small difference in the interest rate can save you tens of thousands of dollars over the life of the loan. For example, someone with a credit score above 760 might qualify for a rate a full percentage point lower than someone with a score below 680. Work to improve that score. Pay your bills on time, keep your credit card balances low, and dispute any errors on your credit report. Finally, the down payment. The traditional wisdom is 20%. On a $400,000 house, that's $80,000. Daunting, right? While a larger down payment avoids private mortgage insurance or PMI and lowers your monthly payments, it's a huge hurdle. There are low down payment options, 3% or even 0% for certain government-backed loans like Federal Housing Administration or FHA or Veterans Affairs or VA, but those often come with their own drawbacks like higher interest rates or the aforementioned PMI, which protects the lender if you default. PMI can add another $100 or more to your monthly payment. Okay, let's look at some real-world scenarios. Who can swing it in 2026? First, the high-income earner. Think tech, medicine, law. They've got a definite advantage, but even they aren't immune. It's easy to fall into lifestyle creep. Bigger house than needed? Fancier cars? Over-leveraging is a real risk. Just because you can qualify for a huge mortgage doesn't mean you should. Next, the dual income household. Two incomes definitely ease the burden. The key here is financial compatibility. Budgeting together, aligning financial goals. It's crucial. One partner's spending habits can torpedo the entire operation. Then we have the frugal saver, the minimalist. These are the folks laser-focused on early retirement or financial independence, retire early or fire. They're masters of aggressive saving, side hustles, and location arbitrage, moving to less expensive areas. They might sacrifice now to own a home sooner. The investor or entrepreneur is another archetype. They use real estate as a tool. House hacking, renting out spare rooms, fix and flips, rental income. They're leveraging their skills to build wealth through property. Finally, we need to acknowledge the inheritor, or those receiving generational wealth. Inheritance definitely plays a role, giving a massive head start. It's a privilege, yes, but also comes with the responsibility to manage that wealth wisely. Okay, so you're not a high-income earner, you're single income, no inheritance coming your way? Don't despair. Here's how to fight back. First, career advancement. It's not just about a job, it's about a career trajectory. What skills are in demand in 2026? Project management, data analytics, digital marketing, cybersecurity? According to the Bureau of Labor Statistics, jobs in computer and information technology are projected to grow 15% from 2021 to 2031. That's way faster than the average for all occupations. Upskill, take online courses, get certifications, network. Your earning potential is not fixed. Second, budgeting and financial discipline. This isn't just about tracking your spending, it's about understanding where your money actually goes. Use budgeting apps. The 50-30-20 rule can be a good start. 50% of your income for needs, 30% for wants, 20% for savings and debt repayment. Automate your savings. Treat it like a bill you can't skip. Third, debt reduction. High-interest debt is a wealth killer. Credit cards, personal loans, tackle them aggressively. The avalanche method, paying off the highest interest debt first, can save you hundreds, even thousands of dollars in the long run. Consider balance transfers to lower interest cards, but watch out for fees. Fourth, investing and wealth building. Don't just save, invest. Even small amounts can grow over time thanks to the power of compounding. Consider low-cost index funds or exchange-traded funds in a taxable brokerage account, Roth individual retirement account, or traditional IRA. Understand your risk tolerance. Time is your ally. Finally, explore alternative housing. The single-family detached home isn't the only option. Condos, townhouses, even manufactured homes can be more affordable entry points. Co-housing, where residents share common facilities, is another possibility. Location is key. Are you willing to move to a less expensive area? Location arbitrage can drastically improve affordability. So, what does the future actually hold? Predicting the housing market is a fool's game, but we can look at trends. Interest rates. The Mortgage Bankers Association predicts rates will likely remain elevated, but we could finally see them inch down just below 7% by the end of 2026. Inflation? Hopefully it will cool, easing pressure on construction costs. Government policy? Keep an eye on potential first-time homebuyer programs or zoning reforms. Technology? Construction technology, 3D printing, could bring costs down, but that's still further out. Let's recap. To afford a home in 2026, you need a plan. Boost your income, control your spending, crush your debt, invest wisely, and be open to alternative housing options. Okay, viewers, time for action. Step 1. Assess your financial situation. Use a budgeting app. Calculate your debt-to-income ratio. Know your credit score. Step 2. Set realistic goals. How much can you save each month? What skills can you develop to increase your income? Step 3. Take concrete steps. Apply for that promotion. Start that side hustle. Automate your savings. Even small steps add up. I get it. This can feel overwhelming. Homeownership might seem out of reach right now. But here's the thing. Financial well-being is the ultimate goal. Building wealth, securing your future, that's what truly matters. Homeownership is just one potential piece of that puzzle. Don't fall into the trap of thinking it's all or nothing. Focus on progress, not perfection. Every dollar saved, every skill acquired, every debt paid down, it all moves you forward. Remember, financial literacy is power. Self-improvement is the ultimate investment. And with the right mindset, the right strategies, you can achieve your dreams, no matter the economic climate. The dream of owning a home or financial freedom, it's not dead. It just requires a little more hustle, a little more smarts, and a whole lot of you.